I think going forward, putting aside the geopolitical concerns for a second, I think, that just on the capex cycle alone, we're probably due in the coming 5, 10 years for rising energy prices on average, and more capex needed to bring supply online and to maintain existing supply to meet demand. But then when you kind of overlay on top of that the geopolitical issues, there's certain pockets of supply that could go offline pretty quickly. You could wake up to a headline and just there's disruption. So during the rise of shale oil, there's more surprises to the downside in the oil market that are possible to happen, whereas now we're in an era where there's more upside surprises that can happen. But even without those upside surprises, energy companies in general are pretty well positioned at current oil prices. They make decent profits. They're trading at low valuations. They have good balance sheets because they used a lot of these last few years of decent energy prices to kind of reinvest in their balance sheet. And so overall, I think from an investor standpoint, it's an interesting area, but then also from a risk standpoint, it's important to watch because obviously higher energy prices could disrupt things elsewhere in your portfolio or elsewhere in the economy.
In a recent analysis by finance expert Lyn Alden, insights into the oil market reveal a potential boom on the horizon. With a historical 15-year cycle of bear and bull markets in commodities, coupled with the maturation of U.S. shale production, the stage is set for rising energy prices. Alden emphasizes the crucial role of capex cycles and geopolitical factors in shaping market dynamics. Moreover, burgeoning demand from emerging economies like the BRICS nations underscores the resilience of the oil market. Despite environmental concerns, pragmatic responses to energy crises highlight the ongoing importance of traditional energy sources.
Oil and other commodities tend to go through certain capex cycles. And so, there's a period where there's, oversupply, prices are low, and so companies are not aggressively investing into bringing new production online, and demand keeps steadily growing over time, and existing reserves start to get thin, and eventually that results in more scarcity and more upward price pressure. But then it takes time for CapEx to be enticed to come into the space, and then it takes time for those projects to come online. And so you normally have a multi-year significant bull market until there's been kind of sufficient CapEx or sufficient demand destruction from the higher prices to reach kind of a new equilibrium. And then they kind of start that process over again where now there's oversupply because of all that lagged capex coming online, and you go through a period of lower prices, lower capex, and kind of start that cycle again. And that's a fairly long cycle. That's like a 15+ year cycle. Historically, it might be, a decade or two of kind of a bear market in commodities and then a really good decade for a bull market in commodities and kind of start that over again. And so that, we're kind of deep into a period where a lot of energy prices, a lot of commodity prices have been stagnant for a long period of time. They've had cyclical highs, they've had cyclical lows, but for example, we're lower in the oil price than we were about 15 years ago compared to that peak that it hit. And so overall, they've kind of been in that bear market range. The next factor to consider is that when shale oil came online, right? So prior to that, a lot of focus was on conventional oil production, but the combination of new technologies and low interest rates allowed for this kind of unprofitable rapid build out of U.S. shale. And a lot of that was not free cash flow positive when it was done, and that the industry got punished for that. But over like the 10, 15 years of that happening, the global markets now kind of include shale as part of the baseline. Right. So, we're probably not going to bring another amount of new shale oil on over the next 10 years that we brought on over the past 10 years. Right. So that doesn't mean that U.S. oil production is going to collapse. It just means that the rate of upward change, that the bulk of that is likely behind us. And so oil went through this long kind of consolidation. Then the past kind of 5+ years, 6, 7 years even, in that whole kind of shale, the end, like the later portions of that shale period were very negative for pricing because that was kind of a rapid change in the supply side of the oil market. But that had the effect of now, oil's kind of a left for dead market. There's not a lot of capital that wants to be there. The capital that is there is telling oil companies, look, don't keep putting your profits into the ground. Return it to shareholders with dividends and buybacks and improving your balance sheet, kind of like solidify what you have. And so there's not a lot of rapid capex. And so I think going forward, putting aside the geopolitical concerns for a second, I think, that just on the capex cycle alone, we're probably due in the coming 5-10 years for rising energy prices on average, and more capex needed to bring supply online and to maintain existing supply to meet demand. But then when you kind of overlay on top of that the geopolitical issues, there's certain pockets of supply that could go offline pretty quickly. You could wake up to a headline and just there's disruption. So during the rise of shale oil, there is more surprises to the downside in the oil market that are possible to happen, whereas now we're in an era where there's more upside surprises that can happen. But even without those upside surprises, energy companies in general are pretty well positioned at current oil prices. They make decent profits. They're trading at low valuations. They have good balance sheets because they used a lot of these last few years of decent energy prices to kind of reinvest in their balance sheet. And so overall, I think from an investor standpoint, it's an interesting area, but then also from a risk standpoint, it's important to watch because obviously higher energy prices could disrupt things elsewhere in your portfolio or elsewhere in the economy. I think that's part of it. It's hard to quantify it, but it definitely shows up in the, when you analyze a company, what they're talking about. I think even if you excluded that for a second, just the sheer fact that shale was so unprofitable during its rise and companies that just kept plowing money back into new projects and never really became free cash flow positive were eventually punished for that. So I think, even aside from the ESG green stuff, I think there's a normalization. Basically, investors are tired of just lighting capital on fire and saying, look, if we're going to do a project, I want it to be profitable. I want you to, prioritize strengthening your balance sheet, returning cash, and really only invest when it really makes sense to do so, a higher hurdle for investment. But then on top of that, I think the market is less quick to adjust to changes because they have it strongly in their narrative that they need to invest elsewhere, that EVs are going to eat market share, that other energy, is going to come online, even though it's still a very tiny percentage and is expected to continue to be a very tiny percentage. And then also there's, when you're kind of calculating the risk of a new project versus paying dividends or buybacks, they have to consider things like windfall taxes or penalty tax or regulations assigned to them that they can't necessarily model. And whereas returning capital to shareholders is one of the lowest risk uses of capital. And so I think all of those factors are kind of coming together to make it definitely an area worth watching. Again, whether you're looking at it from an investor standpoint or a risk standpoint, kind of like how it could affect your other investments. Yeah, I think that's a huge factor. I think that's where the bulk of demand is going to come. It's going to come from the BRICS countries, the emerging market countries, the faster growing populations. And a lot of those countries, even though some of them consume a large amount of energy in absolute terms, it's still a very small ratio in per capita terms compared to the United States or Europe. So China, even though they're a very large consumer of all, energy and all commodities, on a per capita basis, it's still pretty modest. And so it's natural that a lot of those people want to eventually develop in a similar way that wealthier countries did in the past. We went through a big hydrocarbon cycle. Now it's somewhat less about energy growth and more about kind of productivity growth with that energy, but they still have that core energy growth to still continue for quite a bit. And I think that even as China maybe slows down in that regard, I think India is still on kind of the hockey stick, like upward ramping part of that. Hopefully Africa as well. Some of the countries there are still consuming very little. So I think that's a factor. We've also seen when push comes to shove, developed markets will step down, right? So I think the way that I phrase this generally is that there's been a problem between like engineering and optics, right? So politicians often manage for optics, whereas, if you're an engineer, you actually have to make the system work. And so, some of those green technologies have a role. I mean, solar panels are useful if you want to be off grid. Obviously, if you want to have space systems, there's use for that energy. The problem is when you put it into places where it's not optimal for, say, political reasons or things like that, rather than an engineer deciding this is the best place for this type of energy. And so when energy crises happen, narratives kind of shift because people get angry. And so, for example, during the European, natural gas crisis, when they abruptly lost their supply from Russia, you saw Germany, for example, pivot heavy into coal. And one of the downsides is too, so Europe was trying to push the green ESG stuff. The second they needed all that, right, as soon as they had to displace their Russian gas, they went one to coal, Two, they went to LNG, so liquefied natural gas. Now, that's a finite market globally at any given time. They can build new capacity over time, but it's an expensive, slow process. And they basically said, look, we're going to outbid almost everybody else because we have to. We have the money and we have an energy crisis. So the countries that ended up suffering were like Pakistan and other frontier or developing countries that basically, they were going to get natural gas, but then they got outbid in that LNG by, Europeans that needed to fix an energy crisis. So a lot of that, kind of those kind of mismatch between optics and engineering, when push comes to shove, one is thrown out the window, and two, it's often not the country that made the error that gets punished for it. They get kind of displaced by them. And so there's a lot of factors there.
Thanks for tuning in to today's analysis on the oil market dynamics. We've delved into the intricacies of capex cycles, the impact of shale oil, and the interplay between geopolitical factors and market trends. Remember, while historical data suggests a potential for a bullish market ahead, it's crucial to consider the broader context of energy investments and their implications. Don't forget to hit the subscribe button and give us a thumbs up if you found this content valuable. And as always, share your thoughts and opinions in the comments section below. Until next time, happy investing.